US stock market bubble at that time. All I'm saying, bubbles can occur even under constant money or sound money. But the achievement, the lifetime achievement of Mr. Greenspan and Mr. Bernanke is really that they created the bubble in everything. I mean, if you look at 2002 to 2007, everything went up. Stocks went up, commodities went up, surprisingly also bond prices went up. In other words, interest rates continued to go down. And art prices went up, real estate prices, and this globally, everywhere in the world it happened. And there was only one asset class that went down here, 2002 to 2007, and that was the US dollar. Then 2008, something very interesting happens. The US dollar is strong and everything collapses. And then we come to major turning points. And again, this is a big question for investors. October 28, 2008, the Chinese stock market bottoms out. The resource sector stocks and several industrial commodities bottom out in December 2008. The dollar peaks out at the end of February 2009. And the stock market bottoms out 666 on the S&P on March 6, 2009. And from there onwards, all asset prices go up again. But the dollar is again weak until recently. Then after November 25th, 2009, the dollar begins to strengthen. In other words, the euro peaked out at 151 at that time, November 25th, 2009. Dollar starts to strengthen. And it's then followed by renewed weakness in asset markets recently. So this is a very important relationship to understand. Weak US dollar is a symptom of expanding global liquidity, and a strong US dollar is a symptom of tightening global liquidity, not necessarily induced by Federal Reserve and other central banks' action, but by the marketplace. Now, the Federal Reserve, of course, they love to see these asset prices go up. That's what they want to engineer. The problem is, this time around, that unlike previous recessions post-Second World War, like 73, 74, 81, 82, and 1990, when home prices dipped briefly because of California, this time around, home prices went down significantly. Of course, the Treasury and the Fed will say, oh, the problem is home prices went down. But I want to tell you something. After 1997 in Hong Kong, home prices went down by 70%, 7-0. None of the major developers went bankrupt. Very few households went into foreclosure. Why? Because the difference is the level of debts that is in the system. Here in the US, in the 1950s, homeowners' equity was still 80%. So if someone bought a house for $1 million, or it didn't exist at that time, but say for 100,000, then he had $80,000 equity. And in the 1974, 1982 recession, it was still 70% homeowners' equity. Now we dropped to something like 40%. That is the problem, the leverage in the system. But that escapes the attention of the Federal Reserve. Now, I mentioned earlier on when the Federal Reserve increased the interest rates from 1% in June 2004 in baby steps to 5.25%, that there was never any monetary tightening occurring. The reason I mentioned that is if you look here at credit growth in the system, in the June 2004 quarter, it was running at 7% annually. Then, as they increased interest rates, credit growth accelerated from an annual rate of 7% to an annual rate of 18%, as they were moving up interest rates. But, I mean, you have to ask yourself what they were smoking at the Federal Reserve. Because, I mean, they couldn't see that this accelerating credit growth as interest rates were going up would not be sustainable when actually a lot of private sector economists, some of who are even here today, like David Tice and others, pointed out that this was, of course, unsustainable and lead to a major bust. Now, the private sector post-2007 acted rationally. The banks tightened lending standards and individuals tightened their belt and spent a little bit less money. And so the savings rate went up and credit growth slowed down, and on the private sector it turned negative. But obviously, in a credit-addicted economy, a slowdown in credit growth is of course poison. That the Federal Reserve knows. So what has happened over the last 2 years is this. The private sector contracts now, decreases its credit growth and contracts it. Private credit growth is at the present time negative. A government, on the other hand, increases credit growth through fiscal deficits and monetization, and then you end up with a situation that leads to the kind of economic volatility we have. 2008, the private credit growth contraction exceeds the government credit growth expansion, so asset markets tumble. March 2009, the excessive credit growth by the government begins to exceed the credit growth contraction by the private sector, and asset prices go ballistic, with stock markets around the world going up between 80 and 120%, and some individual stocks going up 5 times. And then recently, the private credit growth contraction exceeds again the credit growth expansion by the government, and asset markets run into some indigestion period. The question is, when will they again print money, and when will government credit again exceed private credit growth contraction? I think it will happen, but some people disagree with me. But in any event, what I'd like to really emphasize, for us to make any forecast how the world will look like in 3 or 5 years, beyond saying it's going to be a roller coaster ride, is impossible. We don't know. That is for sure, but it will be a roller coaster. Number 2, we have to rethink what is a safe asset. Here you have essentially liquidity as a % of market capitalization. Now, as you know, under normal conditions meaning a non-inflationary environment, people will essentially regard cash or investments in treasury bills as the safest. Then longer-term government bonds, then corporate bonds of different qualities, and then equities, more volatile, then growth stocks and more speculative stocks without any dividends, even more speculative. Commodities are probably the most volatile because they have no cash flow. But in an environment such as we have today, and let me explain to you what I mean by that, Mr. Gregory Mankiw, of course an economist at Harvard, but he represents very well the views of the Federal Reserve, in particular the views of Miss Janet Yellen, who is now the vice chairman at the Fed. He says, and he wrote an article in the Wall Street Journal a year ago, the problem is that people are saving money instead of spending it. And we have to get these bastards to spend it again and to essentially get the economy going. So how do we do that? He says, well, the easiest is we introduce negative interest rates. So in other words, all of you go to the bank, you deposit $100,000. In a year's time, you only get back 90,000. Well, he said, well, the problem with that is people will take their money out of the banking system and cash it into banknotes and put the banknotes under the mattress. The selection of the bed will be very important in this case. But in any event, he says, well, if they do that, we have a remedy. We can have a lottery once a year and declare, say, 10% of all banknotes to be invalid. So if you have bad luck and you sleep on the wrong bed, maybe you lose all your money. But on average, people would lose 10% of their banknotes that would be declared worthless. So he said, well, the problem in implementing that is that people will then take the money and convert it into maybe foreign currencies or into gold and silver. So, the easiest solution is we just create inflation of 6% per annum. That is the frame of the mind of the Federal Reserve. And I can assure you, as far as the eye can see, the Federal Reserve will keep interest rates at zero, precisely zero. And by zero, I mean 0% in real terms. They could be at 5%, but if inflation is 10%, you'll still have interest rates at minus 5% in real terms. And if interest rates like in Zimbabwe are at 1,000% and inflation is at 1,000,000%, then they're still highly negative in real terms. And when this happens, when interest rates are negative in real terms, what is the worst investment? Cash is, of course, a bad investment, becomes a very risky investment, except for brief periods of time like 2008 and the last 2.5 weeks. But in general, cash becomes a bad investment. The second worst investment is, of course, long-term government bonds, because if interest rates are negative in real terms for a sustainable period of time, you can be sure that inflation accelerates at some point in future. On the other hand, equities are an avenue to preserve wealth. They are very volatile, but essentially they are less risky than probably cash and government bonds. Of course, then you also have precious metals. But it's important to understand that this is the view of the Federal Reserve, to keep essentially interest rates at zero for an extended period of time. And they'll cheat the public. They may increase at some point interest rate, but the cost of living increases at that time will be much higher than the level of interest rates. A fact, actually a condition that has existed since 2000. The cost of living increases were much higher than the interest rates up to this very day. Now, I have to also mention one point. You may have noticed that I'm slightly critical about US monetary policies, but again, they have had an unintended and very favorable consequence, but not favorable for the US. Let me explain. Here you have the US trade deficit. And as you can see, the trade deficit of the US widened somewhat in the 1990s, but not by much. I also have to mention here at this stage that the Chinese pegged their currency against the US dollar in 1994 at $1 equals 8.28 RMBs, and that for the first 10 years actually not much happened in terms of imbalance with China, or for the first 6 years. But here, after 1998, obviously something changes. The expansionary monetary policies ahead of Y2K, and especially after 2001, that created the credit bubble, lifted home prices, allowed the refinancing boom, homes to be used like an ATM, and the consumer to take money out of their homes and go and spend it. But because of economic policies in the US that are not particularly capital spending friendly, the capital spending didn't occur in the US nor the industrial production. So you have spending in the US and industrial production elsewhere. And so the trade deficit goes up, and the current account deficit also goes up from annually $150 billion here in 1998 to over $800 billion annually in 2006, 2008. It's contracted recently somewhat, but not by much. Now, the US overconsumed. All the statistics show that consumption in the US went way above trend line. This was met by industrial production overseas, in particular in China. And that drove industrial production in China, and it also drove, obviously, employment, capital spending, and the exports then flowed to the United States. But what I want to emphasize is that monetary policies in the US have been a catastrophe for the US itself, because they didn't lead to industrial production growth and capital spending over the next 10 years, or employment gains. There are less people employed in the US today than 10 years ago. But